What if everything you've been told about picking stocks is secretly costing you hundreds of thousands of dollars? Most of us think we can beat the market, but the brutal math says we're wrong. Today, we're exposing the truth. Which path actually builds real wealth faster? Let's dive in. Quick disclaimer: this video is for educational and informational purposes only. It is not financial, investment, or tax advice. Past performance does not guarantee future results. Investing involves risk, including the possible loss of principal. Always consult a qualified financial advisor for advice tailored to your situation. We've all felt it, that rush when a single stock skyrockets. You tell your friends, "I called this one." Your brain lights up with dopamine. It's human nature. We love the idea of being smarter than the market. We hear the legends. The neighbor who loaded up on a winner years ago. The influencer who turned options into a luxury car. And yeah, a tiny handful of people do get it right. But for every winner you hear about, there are hundreds of silent losers who don't post their minus 70% wipeouts. The truth? The average individual investor dramatically underperforms the market. And studies tracking real investor behavior show people routinely earn several percentage points less than the broad market every year. Not because they're dumb, but because emotions drive terrible timing. They buy high on excitement, sell low on fear. Meanwhile, the market just keeps marching. So the big question everyone asks, can I actually beat the market by picking stocks? Or is the boring path the one that wins? Let's run the actual numbers. No hype, just math. Assume you invest $10,000 today and add $500 every month for the next 20 years. Realistic long-term market return before costs? Around 10% annualized for the broad US market, including dividends. Scenario 1, the index fund path. Low-cost broad market ETF. Expense ratio? Just 0.03%. Almost nothing. You own the entire market, hundreds of the biggest companies. No stock picking, no guessing which ones will win next. You simply ride the growth of the economy. Over 20 years, after that tiny fee, you're looking at roughly 9.9 to 10% net annual return in a typical historical scenario. Your portfolio? It grows to approximately $450,000 to $480,000, based on historical average returns. Actual results will vary, and there is no guarantee. Taxes? If held in a tax-advantaged account like a 401k or IRA, minimal drag. Even in a taxable account, index funds are extremely efficient because they rarely sell holdings. Capital gains taxes stay low until you actually need the money. Volatility? Yes, it drops hard sometimes. 30 to 50% crashes happen, but you don't panic sell. You stay invested, and history shows the market recovers and hits new highs. And time in the market beats timing the market every single time. Scenario 2, the stock picking path. You or your expert advisor or fund manager try to select individual winners. The emotional thrill is real, but the math is brutal. First, the odds. Over 10 to 15 years, roughly 85 to 92% of active stock pickers and mutual funds underperform the broad market. That means only about 1 in 10 even comes close, and far fewer do it consistently. Why? Fees crush you. Typical actively managed funds charge 0.8 to 2% per year. Those stock pickers who trade frequently add brokerage costs and spreads. Taxes hit harder. constant buying and selling triggers short-term capital gains taxed at ordinary income rates, sometimes 20 to 30% higher drag than a passive index. Volatility plus behavior. Individual stocks swing wildly. One bad pick or sector collapse can wipe out years of gains. And when the market drops 30%, most people can't stomach watching their hand-picked portfolio bleed. They sell. Then they miss the rebound. Let's model it realistically. Gross market return, approximately 10%. Subtract 1 to 1.5% in extra fees and trading costs. Subtract another 0.5 to 1% effective tax drag from frequent trading. Behavioral mistakes, buying high, selling low, often shave off another 1 to 3% per year for the average person. Net result for the typical stock picker or active investor. Often 6 to 8% annualized, sometimes less. Same $10,000 plus $500 per month for 20 years at 7% net? You end up with roughly $280,000 to $320,000, based on historical average returns. Actual results will vary, and there is no guarantee. That's $150,000 to $200,000 less than the simple index fund, all from the hidden costs most people ignore. Over 10 years, the gap is already noticeable. Over 20 to 30 years, it becomes life-changing. 1% here, on 2% there, compounded, is the difference between a comfortable retirement and wondering why you're still working at 70. And remember, even the pros fail. Reports show that after 15 years, over 90% of large-cap active funds lag the index. The few that win in one decade often lose in the next. Volatility exposes the truth. Index funds spread risk across hundreds of companies. One stock can go to zero. It happens more than you think. Your diversified index? It keeps growing. So, after running the real math, what's the clear winner? For many long-term investors, a simple low-cost broad market index fund approach has historically been effective and builds wealth faster for the vast majority of people. Not because they're flashy, but because they minimize the things that actually destroy returns. High fees, excessive taxes, emotional mistakes, and the brutal odds of consistent stock-picking success. The crowd that chases beating the market usually ends up with less money, more stress, and regret. Here's a simple rule that has worked well for the vast majority of long-term investors. Put the overwhelming majority of your money, around 80 to 100%, into low-cost broad market index funds and simply leave it alone. Automate your contributions. Ignore the daily noise. Rebalance once a year if needed. Let compounding do the heavy lifting. If you want a small, fun money account, maybe 5 to 10%, to pick individual stocks? Fine. Treat it like gambling money you can afford to lose, but never confuse it with your serious wealth-building strategy. One of the greatest investors of all time famously said most people should just own a broad market index fund. He even bet $1 million that an index fund would beat a team of pros over 10 years, and he won easily. You don't need to be a genius. You just need to stop fighting the market and start owning it. If this video helped you see the math clearly, hit like, subscribe, and drop a comment. Are you team index funds or still tempted to pick stocks? Thanks for watching. Now go make your money work harder than you do. See you in the next one.